the Boss Mode, Finance for Founders, and the topic is, should I get a loan? Maureen, have you considered getting a loan before?
Yeah, we have had those instances where we've considered getting a loan to be able to just essentially grow the business, or when we have like projects that are ongoing and there's shortage of fund and you need to complete the project midway, the funds are not there. So we have had instances where we've considered getting loans. It's just that in many cases we've ended up getting an alternative option before we proceeded to a loan. Yeah.
Our money alone is not enough. So like I've been able to take loans for working capital, and so that we can also be able to run our business.
So let's start off. We'll start off with a game. It's continuing on from last week. Should you get a loan? Who wants to get a loan in the next 6 months? I think everyone on the call said they were keen on that.
Yeah, Sky said he's here looking for loans. Hi, Moses.
Moses, you're in the right place. You're in the right place. Okay, so you want to get money in the next 6 months. I know this is a challenge Sky Sales facing right now. It's actually very critical in their business. And can you turn the borrowed money into a lot more money soon? That is fundamentally the question, because the challenge, there's some challenges with loans, right? So how much debt can you take? What factors do you consider? Moses, what factors do you consider when getting a loan? What are you thinking about? Moses, you there?
The interest rate.
Interest rate, George. Yeah, great. Maureen, what do you consider when you're considering whether to get a loan?
Mostly the interest rate and what the loan is meant to be used to do, if the project itself can repay the loan.
Yep, perfect. Moses, you still there?
Moses is on mute. I hope he's not speaking on mute.
Okay.
I think for me, it's also who is giving the loan, because there's some institutions that have a reputation for being very, what's the words? I don't know, hostile. Like hostile lenders. And you hear such bad feedback from other people. So in as much as their loan might be looking nice, I think what people say is important. So I might want to think about that too. Yeah.
Yep, that's interesting. Yeah. So it's like a qualitative aspect of the loan. Yep, very important. So the factors we're going to consider today is interest rate, like you talked about, the total amount that a company can take, and the monthly repayments they're able to take. Actually, the third one is one that most often trips companies up, and it's actually SkySail had applied for a loan with Grassroots Business Fund, received a rejection, and the reason why was because the lender was concerned about their ability to do monthly repayments. I think they were overly cautious. However, this is what tripped them up. So these are the three things we'll cover today. So concerns people often have: you could go into a debt spiral where you're working for the bank. You know, you get more loans to get more loans to get more loans, and you're making revenue, but you're not sure if you're actually making any money. Could lead to bankruptcy, right? So we're going to cover these today so you avoid these concerns and you can make good decisions. Let's do a quick case study. So case study, 40% interest rate. Here's a Fundi on Gong Road. They're getting 40% annual interest rate. Is this a good bet for them? Should they take the loan? What do you think, Maureen? What do you think, Maureen?
It's not a good bet.
Why is that?
First of all, the interest rate is too high.
Yep. Okay. George, what do you think? Was it a good bet?
Yeah, for me, okay, it depends with the amount of money like this gentleman is going to get as profit. Like if he's able to get like 100% profit, or rather, like if he's able to get 100% on the amount he has taken, You can just take out the 40% and remain with 60%.
Yep. That's right. Yes.
Yeah.
Exactly. So I agree with both of you. The interest rate, it feels high, but also it depends is also true. And so we're going to see, okay, what does it depend on if you're able to make enough money? So this comes to a monthly rate of 3%. The question is, can your business generate 3% return a month? If you can generate more or much more than 3%, because you have other costs, right? It's not just the cost of goods sold. There's other things in there, but much more than 3% is a good bet. Let's say for this example, he does one piece of furniture in a month. He has 50K for materials, 50K for labor, and in scenario one, he sells this furniture for 102,000 shillings. George, did he make? Is it a good bet? Did he make a 3% return on his money? George, did he make a 3% return on his money? Maybe lost George. Maureen. George, you there? Did he make a 3% return? So he doesn't make a 3% return here. It's about a 2% return. Let's consider scenario two. He makes 150,000 shillings. It's a more premium vibe he's got going on. Now he's making something like he's put in 100K. He's getting 50K as profit. So the way we think about this is the gross profit is what? It's 150K revenue minus the 100K of cost is 50K gross profit. We calculate a margin here, which is 50K of that gross profit divided by 150K revenue is 33% margin. So you see the margin he's making is much more than that 3% monthly rate. So as a general rule of thumb, we want the margin to be 4 times higher than the monthly interest rate. At least. There could be other factors going on, but that 4x is what covers all the other overheads and the unexpected costs and potential delays. If it's 4 times better, then there might be other reasons, like Maureen's saying, not to take this loan, but the interest rate's actually okay for them. Now,
Go back a bit. So this 4 times, the 4 times higher than the monthly interest rate. You've said this is not cast in stone. If it's round about that, it should be fine. It's not hard and fast, is it?
Not hard and fast. But
Okay.
it's a rule of thumb. It's some guidance. I'm not sure if there's a phrase for rule of thumb in Swahili. The generally accepted, suggested. I need to find the Swahili word for it.
Okay, so sawa.
So Greenwell's got a term sheet from Uncap, and their interest was 90% annually, which comes to 5.5% monthly. Greenwell's gross margin, their commodity business, is 15%. Is this a good bet? Maureen, what do you say? What do you say, Maureen? Is that a good use of money for them? Or George, you there?
Yes, Kyle. I think
Should they take that loan?
Yeah, for me, you should be able to take that.
Why is that?
15 minus 5.5, you remain with 10. Maybe 10 point.
Yeah, you remain with 9.5.
Roughly 10.
Exactly, yeah. So this was a borderline case for them where they weren't sure, to be honest, whether it was a good idea. If you look at this, 5.5 times 4 is more than 15%. So it was a borderline case. They decided not to take the loan because they didn't feel like it gave them enough of a wiggle room in case something went wrong, right? Hopefully that one makes sense there.
No, for me, I'm not understanding what you're saying. Could you come up again? Oh, Carol,
sure.
Have you understood?
Sorry?
Yeah, come up again, Kyle.
Yes.
Yeah. Yes. So you're right that if the margin 15% is more than the 5.5, then this is, in theory, they'll make more money. And if they're very, very careful with their margins, then it's good. The problem is, what if the margins go down for some reason next month? They haven't factored in their overhead, right? So if it's 5.5 monthly interest, but let's say their gross margin 6%, which actually happens sometimes. Some months, Greenwell's has 6% margins. Should they take the loan in that case? That 0.5% is not really enough to cater for their overheads and things like that, right? So that's a more clear-cut case where they definitely shouldn't if it's like 6%. In your case, if it's 15%, 5.5 times 4 is 22%, which is greater than 15. So it's one of those cases where you're like, well, if things go according to plan, it's fine, but if they don't go according to plan, then it's too risky. Not sure if I'm making sense there. Does that clarify, George? Concern? Moses, you there?
Yeah, I was not able to understand.
Yes.
You got it? Okay, great. So I just in the chat, I've put a link to the sheet. So click on this. Click on this link, and then you'll add your email and your company. Here's your email and your company. It'll take like 10 seconds to create your sheet, and then it'll be good to go. Okay. Okay. So I've done things a little bit out of order here, but it's okay. So now I'm going to you're going to see you have a spreadsheet, and I'm going to run through an example company here. So if you follow along on my sheet here, I'm going to talk about a FMCG company. They're doing fortified ugali meal for healthy families, and their revenue right now is 600K a month. Their cost of goods sold, they have a gross profit here of 250K and a net profit of 20,000 shillings a month. They have assets and liabilities. Maureen, do you remember the equation for calculating the equity?
For calculating the equity?
Yes.
No, I don't remember the equation.
So the equation for this is the assets minus the liabilities equals the equity. Assets minus liabilities equals equity. So here's the equity. You can see here the equation here. Assets minus liabilities. I have a business valuation. It's like what we calculated last week, those who are here. And here's the total gross margin for this business. And you can see what the gross margin is here. So it's this gross profit. We're looking at a cash conversion cycle here of 32 days. They have a debt to equity ratio. And the first thing we're going to do is we're going to say they want a loan of 300K. They have annual interest they're looking at is 30% and repaying in 12 months. And the question is, can they afford this monthly repayment? So there's an equation here. Can they afford this monthly repayment of 28,000? In your case, you're going to enter in your own loan. Can they afford this interest rate and this amount of money? So the first thing we were considering was the interest rate itself. This is what Maureen and Babu highlighted. So this 41, oh, sorry. Look here. So this 30% annual interest rate is actually the same as a monthly rate of 2.2%. Can they afford the 2.2? And here you'll get your answer, which is that the safe interest rate these guys can handle is 10%, right? So it's just the gross margin divided by 4. So from an interest point of view, this is an okay loan for them because they can handle up to 10% due to their margins, and the interest rate is just 2%. Question on the interest rate? Write in the chat any questions you have along the way. The next question is, can they afford the amount of money? So the amount they're trying to borrow is 300K. And if you look here, there's something called the debt to equity ratio. This is what determines the amount they can borrow. And so the note here is if bankruptcy is likely in the long term, this ratio will be 1 to 4. If high risk, then it'll be like 4x. And if it's under 1, maybe they should take a loan. As you can see, it's less than 1. And what this is just the debt divided by the equity, liabilities divided by the equity. Another way to think about this is who owns more of the company, the bank or the entrepreneur? If the bank owns more, it's more than 1. If the entrepreneur owns more, then it's less than 1. And from this, we'll calculate the largest loan they could take. If they max this out, if they went to this 4x debt to equity ratio, the most they could take is 2.4 million shillings. And so you can see here, they're only raising 300K, so they're okay there, right? The largest loan they could take is much more than the amount they're requesting. And the next question is, can they afford the monthly repayments? Now, here's the monthly repayment. It's 28,000, and their net profit is 20,000 shillings. What you've seen here is that from the debt service coverage ratio, it's a complicated phrase and word, but all it is the ratio between the net profit and the monthly repayment. And if it's less than 1, they're in trouble. Less than 1 is likely you can't repay. If it's more than 1.25, they likely can be good. And the way to think about this is the profit at the end of the month. The bank wants to think, worst case scenario, can these guys repay? Let's say they're buying a new machine. The machine's delayed on importation, takes a while to set up. They're not really getting the revenue they're expecting from the new product line. Given their existing business, could they still repay the loan? And in this case, they could not. But let's say we change this. Banks, they only like to do like 24 months at most. Let's change it to be 24 months. Now we're seeing, now their monthly repayment is less than their net profit. And so this is the challenge that actually SkyCell ran into with this funder Genue. They're like, back in February and March, your profits went way down, and we're concerned you're able to pay a monthly repayment of whatever the amount was, even though their business had done well since then. So I think they were overly conservative there, but that was the bank's concern, or the funder's concern, was that they couldn't make their monthly repayment. So in this case, the entrepreneur, the interest rate is fine, right? It's less than this 10%. The debt to equity ratio is fine. The 300K is less than the 2 million they could get, but the problem is their ability to repay is not there.
Yeah,
George,
sure.
can I walk through your can I walk through what you've added here in screen share?
Okay. There's some information I'm still trying to get up, but I can be able to share whatever I've done, because I was using both my laptop and my phone. So let me join with my phone, then I'll be able to share.
Okay, I can just share my screen and then you can comment. All right. I think, is my screen visible now?
Yeah, your screen is visible.
My screen is visible.
Mm.
All right. So this is the one for Bell Feeds. You put your revenue in here, your gross costs, your net profit. Okay, net profit feels. Oh, I don't think you put the net profit in accurately yet. I think I'll put in a new net profit. I don't think that's quite the net profit. Cash, accounts receivable. Great. There's also some more assets you have. You have vehicles. You can add those in. This is great that you have payroll, liabilities. And so here's your equity is about 5 million shillings. Great. And then from last week, we did the business valuation. This would be the valuation of your business based on the gross profit times that multiplier. I don't know why it's not. Okay. The 8 times multiplier, right? Okay, and your margins here 26%, cash conversion cycle in 15 days. Great. That's, you worked hard to make that short. Your debt to equity ratio of 1.13. What does that say to you, George? Would you be able to take on more debt?
Yes.
Yes,
Because I can
exactly.
say
Go ahead.
if bankruptcy is likely long term, 1 to 4 is good. I think we are less than 1, so I don't think whether we doing badly off.
Yeah, so under 1, would you recommend taking on more debt? Any
Yes.
public company you'd want the shareholders would be pushing to take on more debt if it's less than, 4 probably. So yours is way, way less than 4. So as soon as you are comfortable with your operation systems, the recommendation would be to take on more debt. And the most you could take on would be 20 million shillings at this point. Does that make sense?
Yeah, it makes
And then
sense.
your safe monthly interest rate is 7%. So it's 1/7 of this gross margin. And yeah, so it's 1/7 of this gross margin here. And 7% a month is like 100% a year. So you could handle 100% annual interest rate. So interest rate is not a problem for you.
Mm.
The only question is the debt service coverage ratio. So if we go here for this amount, a monthly repayment of 28,000, do you make 28,000 a month in profit? So right now, there's no profit number entered in here. So that would be for you to enter to find out if you could handle the monthly repayments. That'd be the only question that we have.
Okay.
That make sense?
Yeah, it makes sense. I'll be able to fill up with the maybe I'll be able to get more information so that I can be able to fill up this Google sheet and see how those numbers are going to look.
Right.
Mm.
Okay, cool. Any questions on that? Maureen, Maureen, you still there?
Yeah, Kyle, I'm still here.
Can I screen share your sheet?
No problem.
Okay, great. Thanks. Let's see what we have. So I've just added in the 8 times multiplier. This is a class that you missed, but whether you're growing fast or growing slow determines sort of where you would fit between a 1 to 8x. So crafty is on the higher end. That was in the last class. Okay, so you put the revenue in here and you put the net profit. It's great. Congrats on the profit. Cash, very little inventory, if any. So your total assets is 1 million and liabilities is 400K. So Maureen, how do you calculate the equity?
Equity assets minus liabilities.
Bingo. You got it.
Hey,
You got it.
flowers.
Yep. That's the net worth of a business. So this is as an equity investor, we see the potential of the business. So we're looking at this 8 million shilling business valuation. A bank is looking at the least your business. The worst case scenarios is worth 600K if you liquidated it. So anyway, that's interesting comparison there. Your margins are 13%. You're very cash efficient, 0 cash conversion cycle days. That's amazing. And your debt to equity ratio is less than 1. Maureen, does that mean that you could take on more debt or not?
We could take on more debt.
You could take on more debt. That's right. And the most you could probably take on is 2 million shillings before you get to that 4x, which is probably not the best idea that much, but you could take on something, 1 million, 1.5 million, right? Your safe monthly interest rate is 3%. 3% annualized comes to about 40% a year. So let's say we have this loan here, 30% interest. Is that, could you handle a 30% interest rate?
Pardon?
What are you thinking?
30% interest rate, yes, we can. It's 30 divided by 12. Yeah, we can. It's not yet at 3%.
Exactly. So you can handle it, so you'd be fine there. And then your debt service coverage ratio. This is, do you have enough profit every month to repay the loan? If things go south, you're buying a new machinery and the machinery takes longer to import than you expected, would you be able to repay the loan?
Yeah.
Yeah, exactly. So this is suggesting that such a loan would be a good fit for you. The interest rate's okay, your debt service coverage ratio is okay, the total amount is less than the total amount you could take on, right?
Yeah.
Cool. Any questions on that?
No, I'm good.
Okay, so these are the BOSSmode tools. We talked about interest rate, total amount, and repayments.
Just being honest.
Hakuna Shida. So this is the rule of 1/4. This is 1/4 the gross profit should be more than the monthly interest rate. Right?
Okay.
Okay, good. Then the next one is the total amount that someone can raise would be determined by their debt to equity ratio. So that's the next tool you have. If you're looking at the debt to equity, it's something to look at every month. Where are you there? This is called leverage. I'm not sure if you've heard of leverage before. Like a highly levered business would mean they have lots of debt. The third one is repayments. So the debt service coverage ratio, can they handle the repayments? Is your net profit greater than the amount of money you have to repay every month? Okay. Anything that you got from this class that you can apply this week to your business?
I've gone home with equity, which are the assets but as liabilities.
Amazing.
And also, of course, the interest rate, which is when you want to see like if we can be able to take a loan and we want to see if it's a good fit for the interest rate. I look at a quarter of the gross profit. Those are only two things.
Exactly. A quarter of the gross profit should be more than the monthly interest rate. Maureen, what did you get today? What insight are you taking home?
I'd say at least now I can be able to evaluate whether taking a particular loan is a good bet or bad bet based on the amount and the interest rate as well as the period, repayment period. Yeah.
Great. Fantastic. Those are great insights. Any questions?